When you're in business, whatever that business might be, whatever shape or size is, there are lots of numbers, lots of areas that you've got to keep an eye on. One of those areas that you need to keep an eye on running your business is on profits and profitability. Profit is still considered a good measure of how you perform in your organisation, how you perform in your business. Now, profit is not a one-size-fits-all term. There are several different types of profits that float around, typically the two main ones being gross and operating, or net if you prefer to use that term. And what I'm going to focus on in today's video is operating profit and what's called the operating profit margin. We're also going to look at how it differs from the gross profit, and I'm going to comment briefly about factors that will influence the movement of that figure. Now, your operating profit margin is a measure of your business's profitability. It will tell you how much profit your business is generating from its core, from its underlying operations. So if you happen to be a theatre company, what you're generating from the performances that you put on, from the restaurants that you run, from the cafes and bars, whether you're a consulting firm, the profits that you generate from delivering those services, or an accounting firm from the services it provides in terms of tax work and management accounts work. It's different from your gross profit margin because it won't include things such as the interest on any borrowings that you have. It won't include taxes that you include in your profit statement. It won't include the interest that you generate from investments. It measures the underlying core performance of the organisation. Now, different terms exist. Net profit, operating profit, EBIT are all such terms there. Now, operating profit is simply working out how much your business is making from its core underlying operations. And it gives us a feeling of comfort. It gives us a feeling of how we're generating those surpluses, hopefully, to actually go for other activities that we might be doing beyond that. Now, the operating profit margin, by the way, is a relative or percentage measure. It's a good indication of how efficient your business is. It also indicates how well your management team are performing as well. A high margin means you tend to generate a lot of profit from your core operations and how your business is running smoothly. A low margin could be a conscious choice on your part, but it could also mean you're not selling enough or your operating expenses, what we might also call overheads, are far too high. So how do we calculate the operating profit and the operating profit margin? Step number one is to calculate your operating profit itself. And then from that, we can work out the operating profit margin. In this video, I'm differentiating between the profit as a financial figure in dollars or in pounds, and the margin, which is measured as a percentage, which is called a relative number. Now, first of all, isolate what your cost of sales are. So if you're a restaurant, what's the cost of food that you're buying in? And take that into account. Take into account perhaps your direct costs, chefing, deduct that from your revenue to give you the gross profit. Things like operating expenses will include things like rent, rates, utilities, salaries, staff, depreciation. All those will be taken into account as operating expenses and they're deducted from the gross profit. Once you have that, you then take that figure that you've got as a financial number and effectively relate that to the revenue that you've generated as well. Now, revenue, by the way, folks, in some courses is referred to as turnover. Some people prefer the term sales, but it's the value that you generate from the goods and services you provide. Let's throw some numbers in there. Let's assume we generate £100,000 worth of turnover, and out of that, we have cost of sales of 50, and we've got operating expenses of a total of 30. Now, a bit of simple maths there gives us 100 minus those two numbers to give us an operating profit of £20,000. Remember, that operating profit can also be called net profit, sometimes called operating profit, or called EBIT as well. And EBIT, by the way, folks, stands for earnings before interest and tax. Now, take that £20,000 figure that we've got, relate it or divide it by the revenue of 100,000, and that gives you an operating profit margin of 20%. That formula, if you like formulas, is the operating profit divided by the revenue multiplied by 100. Obviously, spreadsheets will give you that figure as well. There's a link in the notes, by the way, for a handy tool that we've got to work out operating profit margins as well. It gives you a bit more insight. Now, the number in itself, by the way, is absolutely pointless. And the whole thing about getting a number is what's the yardstick you're measuring it against. Now, granted, that's a topic for another video, but take that operating profit margin, compare it to what you did last month, the month before, compare it to what you did last year, compare it to your budget. And if you haven't got a budget, you need to get one sorted. Again, check out the show notes, folks, by the way, little heads up for our tool called Budget Whiz, which will help you with that. Compare it if you can get the data for a comparable company in your sector, but you need to compare to something to know how you're performing. Now, a movement in that profit margin against what you were expecting, what you were hoping for, could be because you're not selling enough product. It could be you're suffering from what's called economies of scale. And that's a topic I'm going to pick up in next week's video. Now, effectively, if you're not selling a great deal, you've got costs. If you sell much more, some of those costs won't change, and therefore you'll generate a higher level of operating profit margin. Now, again, taking that figure that you've calculated, you need to find an idea about the context and how that's performing against whatever benchmark you choose. You need to have that to indicate to you what's going on in your business, what you need to fix. And it's vital to help you get that data much more easily is that you have a good, solid digital infrastructure. My personal recommendation for most businesses would be Xero for a number of reasons. You can get that data quite easily. You can link it with something like Budget Whiz, which will help you monitor and keep on top of things. Understanding what's going on in your business is vital for you to understand what to improve, what you're doing well, to take those credits, as well as to do those investigations and put things right as well. It could also indicate action plans, perhaps by negotiating with suppliers, finding better way to reduce some of those overhead costs, ways to actually move around with a selling price to increase the value. Answers will come from the numbers that you generate. If you don't actually know what's going on, then you're going to find it very difficult to put things right or to actually build on the successes that you've already got. Playing around with operating expenses in terms of improving them, improving cost of sales will make your margin improve as a consequence. Now, bear in mind this, folks, if you're going to pay more for your raw materials and your utility bills, your rent, your overhead costs, your salary costs effectively increases, what's going to happen? It filters the way through and your margins will drop accordingly, which is something we don't want at all. So what's the final thoughts? Well, there's several. Number one, it's important to keep a track of all your business financial metrics. Number two, being aware and understanding what those numbers actually are, not only just to calculate them, but how to interpret them gives you insights. You need to also make a comparison to something. A plan is ideal. Last year, that same time period is also good, but compare it to where you were hoping to end up. If you don't have comparisons, then how do you know how you're performing? Now, operating profit margin is very, very much on the industry that you're in. Some industries by nature, typically like airline, transportation companies, will have very low operating margin percentages, but they have high levels of turnover. Some industries by nature might be more niche, and they will have different metrics, different financial operating profits as a result. So when you compare, make sure you're comparing apples to apples and not oranges to oranges. Folks, I hope you found this useful. Let me know what your thoughts are, and if you feel that somebody else could benefit from this video, I'd love it if you could share. Look forward to your comments and feedback, and please do check out the notes for some links to some useful resources to help you and your business.